Yeah, I'm losing my edge.
Good,
Not the
good day
most-
to talk about it.
Not the most exciting. People don't normally say, they don't go to the platform and go, oh man, I'd love to cook up some hedging trades today. I'd love to manage risk. And especially to boot, I want to do that in Forex. That's where I want to go. But this is an interesting one, and it's a new take on an old classic here. You've got the small US dollar that's it's been around for as far as I can remember. The US dollar's been around. It's fallen to new lows, Pete, going back to 2018. And a lot of people have ideas on this market. I've got ideas on this market. You and I have had incorrect ideas on buying this market.
We had some early good ideas, but not lately. Yes.
It'll be good at some point. This market.
No, we don't have any more. My inventory has been liquidated at fire sale prices.
And what I wanted to look at here today, Pete, is getting away from having to liquidate those positions amid new lows in the U.S. dollar. Instead of having to liquidate, how can we hedge these positions? And they can easily be hedged. We've talked about this before, and I want to just quickly brush on it if you haven't seen this before. This is a U.S. dollar product. Remember that dollars are priced in other currencies. In the same way, if you ever traded euro futures or ETFs, they're priced in dollars. The same thing occurs here with SFX futures. They're priced in euros and Mexican pesos and Australian dollars and Chinese renminbi and Japanese yen and all down the line there. And so what you can do pretty easily is say, okay, well, I bought dollars or I sold dollars. I can just go to that euro market and trade the opposite direction of that euro market to hedge a little bit there, because you can see they move almost perfectly inverse. So if I bought down here and this is where it gets a little bit funky. If I bought SFX futures and I want to, in essence, sell a call option against that, what I could do is I could go to euro futures or ETFs and actually sell a put. Because remember, you have to flip that. It's dollar. You bought dollars in euros, and so you need to actually get some long deltas here in euros against that long SFX position. And I've laid it out pretty simply. We've talked about this before, Pete. The futures market, you could look at a 10 delta put or a put spread that's short the 20 delta put and long the 10 delta put in /60. You can go to the ETF and look at shares or look at options. And what I would even do is just look at the 50 delta put actually. So that way you're just partially hedged in the euro ETF. You could also do it in yen futures. You could do it in pound ETFs and all down the line. We've talked about this before, and I don't mean to not let you get a word in. What I want you to get a word in, though, is the new part of this. I did some number crunching, Pete, and I want to see how intriguing this is to you. I looked for the highest and lowest correlations to the U.S. dollar market out of stocks, out of commodities, out of a ton of different products, Pete, over 500 different tradable products out there. And I found the highest correlation, S&P 500 volatility. So VXX, VIX, anything like that. And the lowest correlation, gold, silver, and tech stocks. And I found this kind of intriguing here because you could also, this is nothing to scoff at. Like a negative 0.6, negative 0.7 correlation in metals. Do you ever think about potentially taking that long SFX bias and hedging it a little bit in some of these places?
Well, long SFX, long metals. Yeah. There is, the economic thinking behind that is as the dollar gets cheaper, you can buy more metals with your dollars. So a cheaper dollar tends to lead macroeconomically to higher gold prices. Again, that's another kind of curve-fitting mathematical fallacy, I think. I'm a little surprised to see the weak dollar long metals trade has been an interesting trade. The correlation to silver I find really interesting. I didn't think, especially, and when I say that now, has the dollar moved? Yes, but it hasn't moved that far, that fast in the last 3 months.
Sure.
And while silver is back to $24, still in that range of 22 to 28 bucks. So the correlation is pretty, for me, it's pretty darn interesting.
Yeah, it is pretty interesting, and it sets up honestly for a pretty good trade because metals here in orange have gotten knocked down, a little bit of a bounce yesterday, but they've gotten knocked down off of these highs as dollars make all-time lows. I kind of like a long dollar, long SPRE trade here, and I messed this up. This is STIX. I like a long SFX, long SPRE trade here. The only thing that I would amend it, the small exchange futures trade they're all about a 1-to-1 trade. I would get a little bit overexposure in that US dollar. I would go 2 SFX contracts and then long 1 SPRE contract. I think this is an interesting way to hedge foreign exchange outside across asset classes here, not just within that Forex asset class that gets honestly kind of complex. It's like, okay, I'm buying US dollars and I'm short euros and now I need to get long euros. And it's kind of a hodgepodge. You could think of it this way. Dollar is at its lows. Metals, gold, silver are priced in dollars. So as that dollar depreciates, gold and silver should, all else equal, appreciate a little bit relative to that dollar. So I like the long 2 SFX, long 1 SPRE. I think if you see that bounce in dollar, you're hoping for metals to just hold in. But if the dollar continues to appreciate against you here, you should see this metals market at least ascend a little bit, hopefully get close to its prior glory here, highs that it's not even close to right now. I like that, a new way to hedge foreign exchange.